My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. To my friends, I'm just trying to make you a little money. My job's not just entertain, but to explain what the heck is going on. So call me 1-800-743-CNBC. Tweet me at Jim Cramer. Did you ever wonder why more people haven't become millionaires from owning stocks? I'm sure you have. And I'm going to tell you why. ASML Holdings. That's why. I know that on another great day where the Dow jumped 338 points, S&P gained 0.47%, and the Nasdaq advanced 0.28%, you're probably wondering, what the heck is Cramer talking about with ASML? In fact, what the heck is ASML? That keeping people from making big money in the market? Was that what it does for a living? No. No, look, I don't mean to insult the 42,000 people who work at this incredibly good Dutch semiconductor equipment maker. ASML's at the forefront of what's known as affordable shrink, meaning, and I quote from their annual, the ability to make smaller, more energy-efficient transistors at the right price. Smaller transistors translate directly into better, more powerful, less heated chips. Very important technology, which is why ASML gave a horrendous forecast yesterday, something it did actually by mistake. They got the date wrong for the release. Lots of investors figured that it must be game over for the semiconductor stocks themselves, as ASML stock has plummeted from $872 to $683 over the last 2 days. It was natural to assume that such a huge shortfall must be the result of the weakness across the board from all of its clients. While ASML is relatively unknown versus the American semiconductor equipment companies Applied Materials, KLA, Lam Research, that just made it even more mysterious and thus inscrutably terrifying. I give you the elongated introduction because once this company spoke somewhat incoherently, I might add, the world caved in for the semis. This just happened yesterday. It got obliterated. Every one of the chip stocks, including the ones involved with artificial intelligence, was crushed. Doesn't matter that ASML said they're still getting tons of orders from companies that make AI-related chips. It was the one bright spot they had. No one believed anything was any good here because the guidance was so horrible. And you know what we say? The guidance is, well, the guidance. No matter. The instant reaction, a plethora of stories about how to play the end of the semiconductor bull market. That's right, the end, because it was dying. There were many money managers and writers falling all over each other just at the close of yesterday, at the closing bell, to write the definitive obituary for this group, even as it's less of a group than more of like a parliament of owls that's somehow been combined with a pride of lions, two very different beasts. As I watched and listened, I said to myself, this terrible miss by some abstruse Dutch outfit is going to make people to miss out on what could be the next leg of a powerful semiconductor rally, fueled by the wall of worry and skepticism that's being built right in my face. In short, ASML and negative one-off stuff, just like it, are the reasons why I have to say, NVIDIA, own it, don't trade it. All the time I say it, because people cannot withstand the fusillade of negativity like we had yesterday coming from commentators who really don't know anything about NVIDIA, except that you're supposed to panic. You're supposed to sell. And even if it's down 5, you've got to leave, because that means the rally's over and it's time to call it a day. Last night I told you this was the height of idiocy, but nobody cares that I say that. And I guess that's because I've been saying it since NVIDIA was at $2 and now it's at $135. No credibility for me, because I'm not trying to scare you. Sure enough, today NVIDIA comes right back up, this time without all the timid summer soldiers and sunshine patriots, thank you Thomas Paine, who got blown out yesterday. Only those who stuck to their guns or simply ignored the ASML news, maybe out of genuine ignorance, managed to hang on. What was happening at the exact moment that people were squeezing into the exits because of ASML? NVIDIA CEO Jensen Huang, a man with boundless energy, was giving a speech at the Lenovo Tech World Conference. How did we miss that one? Where he said that, quote, NVIDIA would like to achieve essentially superhuman productivity, end quote. He told the enthralled crowd, quote, this is going to be the largest of industrial revolutions we've ever seen. And we're seeing in the last 12 months or so just an extraordinary awakening in every single industry, every single company, every single country, end quote. So on the one hand, we have the punch-drunk ASML and its cornermen shouting, get out now, throw the towel, even as ASML said AI chips are doing great. And on the other hand, we have the redoubtable Jensen Huang, the man who almost single-handedly kickstarted the AI revolution, telling you how the world is being reinvented. Jensen's not sitting there trying to figure out how to dump his stock. In fact, he probably isn't thinking about the stock at all. In fact, he told me he never thinks about it. He's just hoping that the company that manufactures his chips, Taiwan Semi, can get enough machines from, yes, ASML in order to scale up production. ASML is the only outfit that supplies the key machines to make these highly advanced chips that are really in short supply. You need that equipment to make chips with tremendous speed because, as Jensen says, quote, speed is sustainability, speed is performance, speed is energy efficiency, end quote. I don't think the need for speed is going away. In fact, it's only going to increase, especially when tech companies and utilities are fiercely trying to put up nuclear power plants to meet the energy demands of NVIDIA chips. You see the utility index was the leader today? Now, there's one issue with nuclear power, by the way. These plants won't be ready for 6 or 7 years. They better hurry up because everyone else has concluded that the huge ASML shortfall from yesterday means the entire semiconductor industry is dying or it is dead already. Yep, when you see Amazon announcing a nuclear deal today, do you just think, oh, what a bunch of bozos they are? Don't they know that ASML's telling you to pull up your tent? Do you think Amazon's as stupid as Google and Microsoft, both of which are signing long-term nuclear deals? Are they just a bunch of hyperscaling clowns? I think it's more likely that the people who dumped the AI-related chip stocks yesterday are the clueless ones. Look, there's a stunning lack of comprehension about how NVIDIA and artificial intelligence work. You can't just order 100,000 Blackwell chips, the latest and greatest NVIDIA product, and be done. They're packed with software, and as Jensen told me, software never dies. As long as there are new inventions and new uses for computer power, there'll be more need for these chips, and you can attach them to the software no matter what the iteration. You just have to keep buying them because you have to keep up. Right now, we have revolutions just starting in healthcare, manufacturing, climate change, cybersecurity, autonomous driving, and even robots. AI-powered revolutions that are about 18 months old. That's all. Is the party really over if the revolutions just began? Hey, I heard a couple of hedge fund managers say that it's bad for NVIDIA. And they have to be right because they're rich, right? Isn't that how it works? Right? They're rich, so therefore they're smart. They're therefore they're right, so sell NVIDIA. So, yes, call me jaded. Say I drink the Kool-Aid at NVIDIA's headquarters, maybe with a hit of my wife's mezcal. By the way, I didn't see any water fountains there, but there was a bar with tables made of slabs of giant tree trunks. But just understand that when a company as poorly communicative as ASML is able to point out that its business that goes into AI, the one that's for the parliament of owls, not the pride of lions, is still strong, maybe, just maybe, they really mean it. Of course, the show will end tonight, and you'll say, what was that guy Cramer screaming about Nivea cream? I mean, I saw an ad that said everyone with half a brain or two brains or whatever is a seller of NVIDIA, so what the heck, count me out. But here's the bottom line, people. It's because those people who watched all that stuff want to be counted out that they haven't made millions of dollars in the stock market, millions of dollars. If you just ignored the constant negativity, NVIDIA alone could have given you a monster. Get this, write this down, 32,000% total return in the past decade, most of which we caught on Mad Money. I think it's still got juice, which is why I always say, NVIDIA, own it, don't trade it. Ann in Indiana, Ann.
Jim, thanks for taking my call. So grateful that you brought up conviction during the club call today. So I'm hoping you could chat about that in reference to Berkshire B shares, because I'm wondering after the club call today, maybe I'm a little heavy in financial stocks and I could lighten up on Berkshire B, but maybe it's
No, I don't want you to do that. I don't want, first of all, Ann, thank you for the comments. Thank you for being on the club call. Jeff Mark thanks you too. Do not lighten up on Berkshire B. And by the way, that company is more levered to natural gas than it is to anything else. It does have a big cash position, levered to insurance. But Warren Buffett has put together an amazing enterprise, and I am urging you to hold on to that and let it run. Now I want to go to Sam in my old home state of Pennsylvania. Sam.
Jim, how are you?
Sam, I'm doing real well. How about you?
I'm all right, Jim, but I got to tell you, I am concerned about Snowflake. You know, this is an environment where a company like Snowflake should be doing well given the AI spend and what they do with data warehousing. But the company, trading at 14 times sales, has yet to prove itself as to why it's trading at such a high valuation. We're looking at negative earnings growth over the next year, and free cash flow is negative. The only thing that seems to be growing here is stock-based comp. What do you think?
Sam, I got to tell you, I think you're very right. I mean, look, I think Sridhar Ramaswamy is doing a good job, but everything you said is true. You've got to put up good numbers in this market if you're going to have this stock go higher, and it's not they have to put up a very big 2026. Not just, I know 2025, I don't think they can do it, but 2026. And then I think you'll be able to say, you know what, I want to get in ahead of that. But until then, I agree with Sam. I think it's very, very tough. All right, so listen to me, people. I'm sorry I'm a little fired up about this. I had my club call today, and I'm just a little upset because I saw it happen last night, and knew it was going to unravel. You're able to ignore the negativity surrounding stocks. I think you'll be able to generate the kind of returns that just crush your paycheck, and that's what I want you to do. Just take the negativity facing NVIDIA. You've been able to tune it out. Think about what you could have done in your life. On Mad Money tonight, earnings season is in full swing with the big banks kicking off the action. I also find it important to check in with some of the smaller regional players to get a closer look at the corners of our country because there's real money being made there too. So don't miss my post-earnings exclusive with First Horizon. Then we just celebrated the 2-year anniversary of this bull market. So could the positive trend continue? I'm going off the charts to find out. And there are 2 stocks levered to investment banking and capital markets that I continue to be intrigued here. I'll reveal the names and share whether the positive momentum could continue. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
So far this earnings season, we've heard a lot of good things for the banks. And that now includes the regional banks. This morning, First Horizon, Tennessee-based regional bank, reported a better than expected quarter and saw its stock jump more than 4%. That's all the more impressive because First Horizon had already rallied nearly 6% since we got the first round of bank earnings last Friday. I've always said that First Horizon is a high-quality company. They proved to be a steady operator during last year's mini-banking crisis. Now, though, the stock's up almost 23% for the year, so is it getting ahead of itself or is it just beginning? I think it's the latter, but don't take it from me. Let's check in with Brian Jordan. He's the chairman and CEO of First Horizon to learn more about the quarter and what comes next. Mr. Jordan, welcome back to Mad Money.
Thank you. Thanks for having me.
Oh, of course. Now, Brian, I just want to go right to it. You are buying back a huge amount of stock, and I almost feel like what I'd be saying if I were in your shoes is that if they're not going to buy it, then I'm going to buy it because that's how good the situation is.
That's very well said. That's the way I think about it. We believe that the stock is a bargain at these prices and look for opportunities to buy it. We have plenty of authorization. We've sort of floored our CET1 ratio, our capital ratio at 11%. So we're using that as a governor. But anything above that, we're looking to invest in our stock, return the capital to shareholders.
Now, it does seem also that the one fly in the ointment from last time that you basically flagged, deposit competition, I don't know, is it possibly less in some degree? Because it does seem like you're making a lot of money without having to pay out a lot of money.
Yeah, deposit competition, particularly in the late second and early two-thirds, maybe in mid-September, was still pretty strong across the footprint. Part of it is we're in very good growth markets, and you see a lot of people expanding into those markets, and so you see a lot of competitive pressure from new competitors. It has lessened a little bit. When the Fed cut rates 50 basis points in mid-September, it started to lessen that pressure. One of the highlights for me in the quarter is, in spite of that, we were able to grow deposits basically 3% quarter over quarter versus the H8 data, which is the industry growth over the same period being closer to 1%. Right, so we feel good about what we're seeing.
That's what I've been seeing, 1% across the board. You know, we've got a pretty good money management kind of high net worth research group here and at CNBC. And there's a guy named Robert Frank. He does a great job. And he was saying, look, the money is leaving Palm Beach and leaving Delray, he pointed out, and going to places like Tennessee, and that's where the new growth markets are. Now, I already thought that they've been growing for a while, but is it a second level of growth that's just starting right now?
Yeah, I think you're seeing tremendous momentum in places like Tennessee. We've got others, Texas, they're part North Florida. But you're right. You're seeing people move around. It started with the pandemic in 2020 and has continued to build. The number of organizations that are moving into Tennessee is just phenomenal. The XAI has made a tremendous investment here in Memphis, for example. So we see a lot of investment in the state of Tennessee, and we're very, very encouraged by the momentum across the state.
So tell us what happens at the pace of what the Fed does. For instance, Charlie Sharp yesterday told us in Wells Fargo, if the Fed basically doesn't cut really, really fast, they make a lot of money. If the Fed cuts really fast, they don't make as much money. How are you set up?
That's a pretty fair assessment of how we are. We are asset sensitive, so our net interest margin gets impacted by falling rates. To the extent that you have a series of 50 basis point cuts, that's more difficult for us to manage through than a series of 25 or 25, take a pause, another 25, take a pause. I don't think that financial conditions are extraordinarily tight today personally. And I don't expect that the Fed is going to be particularly aggressive late this year and into next. In our case, we have a very balanced business model in the sense that our mortgage warehouse lending business, our mortgage business, and our fixed income business tend to benefit from falling rates. So we pick up in fee income a lot of what we lose in our net interest margin. So we tend to be very, very balanced through multiple interest rate cycles, which I think is particularly attractive for a bank investor. You're not going to get the volatility that you might otherwise get.
No, that's exactly why I've been recommending your stock, because you get the yield, obviously. Now, one last thing. We had these terrible storms, and they hit areas that people aren't used to getting hit by. What's it like to be the largest bank in an area where suddenly you've got unfathomable damage, and there never been thought to be that kind of damage?
Yeah, it's really hard to imagine or to really understand. It is a complete tragedy, and our hearts go out to the folks in all of these communities, whether it's across Florida or whether it's East Tennessee or Western North Carolina. We've continued to try to bring supplies into those marketplaces to support the communities. We've made a grant from our foundation to support those communities as well. And our people are on the street working very, very hard to help the communities rebuild. I'm confident that this will be overcome, but it has been a painful several weeks, and it's going to be a difficult several months, quarters, and maybe years, but we will get through it.
Well, look, I think those people should be grateful for First Horizon's help, and I know that it's a very, very tough time for you. For the people, I hope everybody does as best as can, but you're a great steward during this period. Actually, a great steward the whole run. We've had you on for a long time, and you always tell it right. That's Brian Jordan, Chair, President, and CEO of First Horizon. Brian, thank you for coming on.
Thank you for having me.
Of course. Mad Money will be back in.
Coming up, chips got checked yesterday, but could NVIDIA be due for a breakout? Cramer charts a course. Next.
What do we make of this market where the averages are within spitting distance of their highs? Again, this is a market that rallied in the historically tough month of September, and it's still climbing halfway through the even tougher month of October. Now, we've had a very good start to earnings season, too, with some great quarters from the big banks, and that's highly unusual. By the way, the big banks are among my favorite leadership groups because when they rally, they can bring many other industries with them. So can this 2-year-old bull market birthday party continue to stampede its way higher? To answer that question, I want to take our emotions out of the equation, as I often do, because we don't want to be complacent. And that's why we're going off the charts with the help of Jessica Inskip. Yep, the first woman on the active trader desk in Fidelity, who's now Director of Investor Research at stockbrokers.com, as well as the co-host and founder of the Market Maker podcast. Now, look, she nailed the bottom in big tech growth stocks this spring, and she's been generally bullish constructive on the major averages all year, and those are terrific calls. So you probably ask, how about now, since she's been so right? Well, as Inskip sees it, things are looking pretty darn good. But even as the rally's broadening out, moving away from just the Magnificent Seven, the whole host of smaller stocks, she says we still need tech to participate if we're going to get another leg higher. Tech doesn't have to lead the way anymore. but it has to at least follow the leaders, unlike yesterday, where the whole semiconductor complex melted down off a hideous quarter from ASML, as I told you at the top of the show. They make semiconductor manufacturing equipment. Never mind that ASML said they still have huge demand when it comes to chips for artificial intelligence. Money managers just sold everything, including NVIDIA, even though NVIDIA is the quintessential AI chip maker, and there's tremendous demand for the machines that make the equipment for Taiwan Semi, which therefore makes it for NVIDIA. Given that NVIDIA is the most important stock in this market, as you know from the top of the show, well, we got to take a hard look at the weekly chart, because Inskip, she mostly likes what she sees here. And what she sees is a bullish backdrop. Specifically, this stock's been forming what's known as a bullish consolidation pattern. You can see it. That means it's kind of like coming together, all right? When I first started this segment, I didn't understand bullish consolidation until I noticed that they always seem to be coming together like this. Bullish consolidation. By digesting its gains for the past couple of years, and once it's finished digesting, well, guess what? You tend to see a cluster going like that, and once those almost cross or get near it, that's when it starts going higher. Bullish consolidation. See, after a huge decline in July and early August, another pullback in early September, NVIDIA's been working its way higher again, making a series of higher lows along the way. However, it still hasn't taken out that high from June 20th. When Inskip sees this kind of action, it makes her think NVIDIA can have a huge bullish breakout as long as it closes above the June high. Basically, if this currently $135 stock can make a close above $140.76, then she sees tremendous upside here. And the pattern looking real good. Inskip points out that NVIDIA's got a nice floor support just under 120. Okay, so you see that. That's the 13-week moving average. If it can break out above $140.76, how high can it go? All right, we're going to use Fibonacci numbers now. That's an ancient, medieval Italian mathematician. She thinks it can go to 127. It's almost embarrassing to say, but I'll just put it right there. She thinks it goes to 177. At 177, it would be by far the world's largest company unless Apple could keep lockstep with it. I don't even have the ability to show you where it is. 177 is like somewhere up here. And when I used to be taller, it would be no problem. Don't get old. All right, anyway. However, she says NVIDIA needs a catalyst to jump that $140 hurdle. As long as it can keep going higher, inching its way higher, then what's going to happen is we're going to get the moving average convergence divergence line, or the MACD, important momentum indicator. When the black line crosses above the yellow line, look how close we are. That's one of the most reliable buy triggers in the business. It's also my favorite, just so you know, because I love MACD. I learned MACD in '88. Inskip says to look for consistently higher weekly closes, because as long as the stock keeps making higher lows, that MACD crossover, well, it's going to happen. And that matters, because according to Inskip, NVIDIA is the key to this market. She will not get a fight from me. How about everything else that's not like NVIDIA? There's a lot of stocks, right? This is why we have the S&P 500 equal weight, where all 500 components in the index have the same weighting, as opposed to the normal market cap weighting, where the index is dominated by the Magnificent Seven. So check out the equal weight. Keep that in mind. Equal weight weekly chart. So one stock's just the same as the other. First, you can see this thing's been doing great because 2024 has been all about the other 493 stocks in the index. Second, Inskip sees a lot to like here. The trading cycle for the S&P 500 equal weight is bullish. She likes to watch the 13, the 26, and the 40-week moving averages, because these represent 1, 2, and 3 quarters respectively. The index has a floor of support at 7058. The 13-week moving average, that's down roughly 250 points from where it's currently trading. There's another floor at 6888, okay, where the equal weighted peaked on March 25th. Right now, Inskip's watching for higher highs. Meanwhile, the relative strength indicator, look at this. Another important momentum, you probably think it's getting overbought, right? And you would think that's dangerous. Some technicians will tell you it's a worrisome sign. But Inskip says you don't need to fret about this relative strength index going higher when the underlying security is still making higher highs. As she says it, the S&P equal weight is not overbought. It's just right. Wow. As long as the S&P equal weight stays above its floor of 7058, right here, then it's going to continue trading well above those key quarterly moving averages, according to Inskip. So she is very positive. Again, remember, this is the equal weight. All 500 are equal weighted. The Magnificent Seven is not overweighted. But as for the regular market cap weighted, take a look at this one. For Inskip, this is a classic picture of a strong trading cycle paired with a strong trend. The S&P has a nice floor of support at 5669, where it temporarily peaked on July 16th based on a 138% Fibonacci extension from the lows 2 years ago. Inskeep thinks it could be smooth sailing to 5,940, up almost 100 points. Again, very meaningful. Lately, the S&P has been bolstered by the non-magnificent 493. If we get some more tech participation, particularly, yes, from NVIDIA, then Inskeep's betting it'll keep roaring. But you do need NVIDIA, you need Amazon, particularly you need Microsoft, and of course you need Apple. Which brings us to the tech-heavy NASDAQ 100, which contains the 100 largest non-financial stocks in the NASDAQ composite, including a great deal of technology. Even though Inskeep believes that the NDX remains in a bullish trading cycle, it hasn't been making higher highs like the S&P. However, the quarterly moving averages are still sloping upwards and acting as forces of support. The NASDAQ 100 has a nice force support at the 13-week moving average, which is currently 19,481, down almost 700 points from where the index is trading. If that level gets breached, there's the 26-week moving average, provided floor at 19,277, and then a prior higher high from the March of 1844. So you see that we have support. As for the ceiling of resistance, the NASDAQ 100 made a higher high back in July, 2690, up more than 500 points from here. Inskeep thinks it's headed in the right direction, but it needs to blast through that July high to have a real breakout. Once it clears that hurdle, she's betting it sends the whole market into rally mode. So once again, strap yourself in. Bottom line, the charts as interpreted by Jessica Inskeep are looking pretty darn good for the S&P and the NASDAQ 100. And of course, yes, NVIDIA. We've got a much broader bull market than we had 6 months ago. But if it's going to keep running, Inskeep says we need to see some meaningful participation from tech. And that's why she thinks NVIDIA is the most important stock in the market. If it can make a higher high, she thinks that's the whole ball game. As for me, I never bet against the fabulous Jensen Hua. Mike in Illinois. Mike!
Hey, Jim, how are you?
Mike, I'm real darn good. How about you, partner?
Awesome. Great monthly meeting today. I really got very
thank you. Yeah, my daughter liked it. My daughter, Jeff Marks and I, and of course, Regina Gilgan. I put the camera on her, but I don't know if you're allowed to do that. Regina runs the monthly meeting in her Basque outfit, and she thought it was a really good call. And that matters because Regina can be very critical, and she said it was good too. So thank you, Mike. How can I help you?
Yep. I'm in ARM holding, and I want to know if I should buy more or sell or hold.
Yes.
Thank you.
Buy. ARM's good. ARM really has a tremendous relationship, by the way, with Masa, with SoftBank. And I've got to tell you, I think that the support there is going to make it so he's got a lot of runway. I like him, except for he's a Raider fan, and I don't know. I think they disbanded that team or they relegated it down to like where Liverpool plays. Anyway, the charts as interpreted by Jessica is good, point to a pretty darn constructive setup right now. But if we're going to get another leg tired to this rally, we need some more participation from the tech sector. Much more made money. Goldman Sachs and Morgan Stanley are both sitting near all-time highs. So if investors miss the move, or could this continue to be a theme to bank on? I'm giving you my take on the two names. And quarterly reports are a great opportunity to reevaluate a position, make sense of where a stock's going. Many don't agree with that, but I'm really stalwart of that view. I'm giving you my tricks of the trade for earnings season that can help you become a stronger investor. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. All year, I've been recommending the two big investment banks, Goldman Sachs and Morgan Stanley. We even own Morgan Stanley for the Capital Trust. Both stocks have outperformed the S&P 500 so far this year, and they really caught fire about a month ago when everyone realized the Federal Reserve was about to bless us with a double rate cut. It's been a little over a month since the Journal broke that story. Since then, Goldman's up over 12%. Morgan Stanley shot up more than 23%. I like these two stocks very much going into earnings season because falling interest rates are great for the investment banks. Just always happen. They make everything easier, from M&A to debt issuance to the IPO market. And now that both Goldman and Morgan Stanley have reported, I got to tell you, I'm feeling pretty darn bullish about the whole industry. Buy. When my former employer, Goldman Sachs, reported yesterday morning, it was once again delivered a set of BAFO numbers. We're talking about much higher than expected revenues, up 7% year over year, thanks to a large part to a 20% increase in investment banking fees, including 25% growth in equity underwriting and 46% growth in debt underwriting. And this is with a not even good market yet. On the asset management side, they had 16% growth. I like that. At the same time, Goldman showed impressive cost discipline. Their operating expenses were down 8% year over year, and their efficiency ratio, that's the cost divided by revenues, came in much, much better than expected. Put it together, and you got a monster bottom line beat. Goldman earned $8.40. Wall Street was looking for $6.89. As for the preferred profitability metric, return on tangible equity, it came in at 11.1%, when the analysts were only looking for 9.5%. By the way, they were very modest in the call about this. They were not bragging, but those were good numbers. On the conference call, management basically said the business is indeed booming. As CEO David Solomon put it, quote, across investment banking, corporates and sponsors remain actively engaged, and we see significant pent-up demand from our clients. Our backlog rose again this quarter, driven by advisory, and we expect our leading investment banking franchise to benefit from the continued resurgence in activity. End quote. That is huge. On the asset and wealth management side, which I was never worried about, my old side, which is a key growth driver for Goldman now that they've mostly abandoned their ill-fated consumer finance ventures, Solomon said, quote, our position as a leading global active asset manager, a top 5 alternatives player, and a premier ultra-high net worth franchise affords us significant opportunities in secular growth areas, end quote. He's gotten back in the business of serving rich companies and rich people, which was always this bank's bread and butter, but they weren't lending. Now they get to do that. That's terrific. Margins go higher. That's, you know what, that's the reason why I still call it Goldman Sachs. Solomon, or the Goldman Sachs. Solomon also had some pretty positive things to say about the broader economy. Listen to this one. Quote, the U.S. economy continues to be resilient. Inflation has been coming down. The recent unemployment data is supportive. And while we've seen some softness in consumer behavior, the tone of my recent conversations with clients has been quite constructive, end quote. Sounds real good to me. While Goldman's customers are, quote, highly focused, end quote, on interest rates, election results, and geopolitics, Solomon explained that's good news for shareholders because the bank can help its clients navigate these uncertainties. That's why you pay them all the big bucks. Overall, it was another excellent quarter for Goldman, bolstered by the incredible comeback in the investment banking business without any real underwritings, real strength on the asset management side, and extraordinary cost discipline from management. These guys went through some pretty lean years, and they have learned how to keep their expenses under control. Now, here's the conundrum. With the stock trading at just 12.6 times next year's earnings, a huge discount at the S&P 500, which is 21 times. I think it's got a lot of room to run because the Fed is finally our friend, and that makes it much easier to own the investment banks. By the way, that price-earnings multiple is just ridiculous, flat-out ridiculous. This quarter was not some one-time episodic move. We have something really bullish going on here, people, and the stock's way too cheap. I would say 15 to 16 multiple. It seems a lot more reasonable. David's doing a very fine job. All right, how about Morgan Stanley? All I can say is I am so glad we own this one for my charitable trust, given that it soared 6.5% today in the wake of a great quarter. Morgan Stanley delivered much higher than expected revenues, up 16% year over year. I was shocked when I read it, thought it was a typo. Their investment banking / sales and trading division put up 20% growth. Investment banking absolutely roaring, up 56%. Equity trading was up 22%, although fixed income trading was only up 3%. I don't know. That's consistent, though, with what we saw from Goldman. Of course, Morgan Stanley's become more of a wealth management play. I've been waiting for this to happen. That segment was up 14%. Their small investment management business up 9%. All aboard! Morgan Stanley also kept its expenses under control very nicely. Expense efficiency ratio of 72%. Wall Street was looking for 75. That's really nice. Remember, with the expense ratio lower, that is better. That's what we get. That all translated into a 29-cent earnings beat off a $1.59 basis. Or if you want to go by, say, tangible common equity for some of you guys who are more fancy out there, it was a 17.5. Analysts were looking for 14.6. That was just a major upside surprise. There are so many positives here. So let's start with the wealth management division. Story continues to be the steady growth in assets under management. Business added net new assets of $64 billion in the quarter, up from a $36 billion increase in the previous quarter, which people didn't like. Total client assets now reaching $6 trillion. When you add the $1.6 trillion of assets under management from the investment management division, what do you get? $7.5 trillion. Remember, Morgan Stanley's targeting $10 trillion in total client assets, and they're clearly well on their way to that goal. They also saw a big uptick in fee-based assets, which grew to $2.3 trillion. Those fees are why I always loved Morgan Stanley's embrace of wealth management, although I did say no to Morgan Stanley and went to gold. Just completely apropos of nothing. As for the institutional security side of things, which was the hottest part of the business, CEO Ted Pick said, I quote, improved underwriting markets combined with increasing participation among financial sponsors and corporates across investment banking support a constructive outlook, end quote. He went on to explain that, quote, a broadening equity market and evolving interest rate policy are favorable backdrops for our markets businesses. Isn't that just music to your ears? It is to mine. Pick was particularly effusive about the prospects for a meaningful uptick in IPO activity, especially from private equity firms. We talked quite positively about this bank on our monthly club CNBC investment meeting today that we had at noon. I should have been more effusive than I even was. You should go listen to the replay. In this morning's interview with CNBC's Leslie Picker, an amazing interview with, Pick and Picker. She made the joke, I'm just cribbing. The Morgan Stanley CEO touted the success of both sides of the business, both the investment banking and the wealth management, but he sounded extra excited about the investment banking boom that hasn't even materialized yet. In fact, he puts it better than I can do. Listen to this.
What I'm really bullish on over time is the beginning chapters of growth across the center, the fulcrum of our investment bank, which is our investment banking franchise, which is to offer advice, to do the underwriting business, but then also how it filters into our great markets business. And I think it's going to take time, but we're seeing it begin. We're seeing the re-equitization in places like India, in Japan, on the continent, and that's going to, as the economy grows, we're going to see that in the U.S.
People, this is the beginning of the move, the beginning. In short, what I've been predicting all along, all year, is finally coming true. Capital markets activity is coming back, and that's going to get even better as the Fed keeps cutting interest rates. Here's the bottom line. With Goldman Sachs and Morgan Stanley both reporting fantastic numbers, Morgan Stanley's were particularly stellar. I'm betting this is just the beginning of an incredible period for the investment banks, and their stocks have much more upside. You got to own one of them. Mad Money's back after the break. It is time. It's time for the light round. Because everybody, that's a right for our call center. Notice he's saying the stock set by myself. The call stock set at the time. I step right to the place. And then the lightning round is over. Are you ready, Ski Dad? Time for the light round. Because I'm going to start with David in Michigan. David.
Jim, thanks for taking my call and for teaching us how to be better investors.
Oh, thank you. Thank you. That's what I'm here for. How can I help?
Oracle bought Cerner several years ago. Jensen Huang said healthcare is a significant opportunity for AI. Do you think Cerner is large enough to move the needle at Oracle? And
it's a great question. I think that the data centers are. Cerner has not been a big payoff yet. It's because Epic, the private company, is doing much better. Epic is going to be working with Jensen. I think that Oracle is going to be working with Jensen. So I like the prospects, but you're in it for the data center, and the data center business is excellent. John in Florida. John.
Jim, thanks for taking my call. Very little conversation in the drug industry about AbbVie. What are your thoughts?
I think AbbVie's doing very, very well. It's not an expensive stock. My favorite in this group right now, though, remains Abbott Labs, which had a monster quarter this morning. Let's go to Nancy in Washington. Nancy.
Hello. What are your thoughts on Core Scientific, please?
Okay, this is a very big cult stock because it's got blockchain and infrastructure, artificial intelligence. It's a mini Palantir. So I think you should just go buy Palantir. Let's go to Joseph in Florida. Joseph.
Hey, Jim, how you doing?
I'm doing well. How about you, Joseph?
I'm fantastic, man. So what's your take on Clover Health, ticker symbol CLOV?
Oh, man, I don't want to get – I know they're doing well. United Health, after what happened the other day with the medical care advantage, I just don't want to go there. I know that it's a good company, but I just don't want to hurt anybody. I'm sorry. So let's go to David in Texas. David.
Hey, Jim. Big booyah from down in Texas.
Nice. What's up?
Hey, first-time caller, Charter Investing Club member.
Oh, thank you.
Love the transparency in the investing club.
Oh, man, there's so much. It's like I'm naked out there. Ooh, horrible thought. What's up?
Hey, this company, you had the CEO on back during the pandemic, and I bought some then as a play on the supply chain issues, but it's been flat ever since. But now the new news is that they are putting themselves up for sale. So the question is whether I should hold on or buy more of GXO Logistics.
Just hold on. Its stocks had a parabolic move, betting a few. RXO, by the way, ringing opening double today. But I think that this is a very valuable company, and even if it doesn't get a bid, I think you'll probably only lose about like 10, 15%. So why don't you hold on and see what you get? Let's go to Dave. Dave!
Dr. Cramer, my mad Tuscan olive grove tycoon, how are you?
Dave, I couldn't be better. Thank you for asking. How about you?
I'm good. I took a hit on NVIDIA yesterday, but it bounced back quite nicely today.
Yes, it bounced back. Tell you, it's like the Chicago Bears, Dave. You can't count them out.
Oh, don't go there, my friend. Jim, like Tim Seymour, Guy Adami, and your own Regina Gilgan, I too am a Georgetown grad.
I did not know that.
Started by 3 Georgetown graduates. Of course, I'm talking about fast food greens company, Sweet Green.
Dave, I didn't know you were Georgetown. Ben Stoto, who is our research director, is also Georgetown. What? Oh, he said that? Oh, he did mention you. I feel like, can we finish the show before we do this reunion stuff? I mean, I happen to know Georgetown. I happen to do a college show at Georgetown. I know someone who went to Georgetown Graduate School, was he the Fed guy? So anyway, Sweet Greens is terrific. I really like it. I love Dave. And by the way, I think the Bears are having a good season. You know, I like Keenan Allen. He's on my team. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Earnings season is incredibly important. This is when we reassess companies, we compare them to the competition, and we figure out if it's time for what's called a re-rating, or if there's nothing of note to hang your hat on. For many, this reevaluation is tiresome, often justifiably tiresome, because what matters is the direction of things, not a snapshot of what's occurring at any given moment. For example, when I interviewed Charlie Sharp, the CEO of Wells Fargo, yesterday, he thought the fixation on that excellent quarter seemed misplaced. The fabulous trend of Wells Fargo is what matters, not the 90 days that was just graded. We can't just wake up and say, holy cow, I thought Wells Fargo was doing badly. Not anymore. See, it's a bit insulting, given all the work that the company's done to make this quarter possible. But for my money, actually, the 3-month report card is vital for trying to figure out whether or not a company's in charge of its own destiny, rather than being hostage to the slings and arrows of the economy. There's a reason the entire industry uses the quarter as the key, I'd say almost all the time. When I got in this business, I assumed it was an arbitrary thing. But I finally got my head around the logic of a quarterly report, thanks to the late Andy Grove, the man who built Intel into a powerhouse back in the 90s. In his amazing book, Only the Paranoid Survive, Grove stressed that tracking and managing metrics over the length of a quarter is actually the perfect measure of how a company's executed. As he put it, the quarter is, quote, long enough to make substantial progress toward objectives, but short enough to identify problems and course correct if needed. That's why it's worth perusing everything that comes out when a quarter is reported, from the news stories to the conference call, and of course, any research you can come across. Grove's admonition makes the most sense when you overlay the quarterly report on the broader macro environment of the moment. So let's say you're trying to figure out which bank has the most control over its fate. Given that every bank's dealing with the exact same macro, correct, you can make a decision about which bank fared the best against that macro. You can then consider previous quarters and come up with an assessment of who's the best of breed over time. I've always favored choosing the stocks of best of breed companies, regardless of the sector they're in. A given quarter may have a ton of activity, a mini banking crisis, a dearth of mergers and acquisitions, a lack of IPOs. You want the bank that's most accountable, most focused, with the best measurables, one that can adapt rapidly to changing conditions. That's best of breed. For me, these quarterly reassessments are often a two-part process. First, a critical assessment of the macro itself, the inputs that a company has to deal with, and how it deals with those inputs, with the quarterly snapshot providing a remarkable opportunity to see if you're paying too much or too little for a stock. You can literally revalue a company on the fly if necessary. Now, the micro, how a company itself is performing, how it works independently of the economy. Is it also integral to being a good investor? You need to know this stuff. But it's a long-term thing. But how a company does in the real world, the macro, a collection of quarterly report cards that tells you how the company did in a time of turmoil in reaction to what's thrown at them, that's perfect for my quarterly revaluation before I pull the trigger. I think it's enough for you, too. I always like to say this, there's a bull market somewhere, and I promise I'll try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.